Welcome to the Foundation's Explainer on the federal taxation of property transactions. We're zeroing in on REG Area 3 today, and we're going to approach this material with absolute professional focus. We'll break down exactly what you need to know to conquer this section of the CPA exam. REG Area 3 tests how tax bases and cost recovery work when property is acquired, converted, depreciated, amortized, or reviewed on a tax return. The main skill is determining the correct basis first, then using that basis to calculate depreciation, amortization, gain, loss, or deductible expense. Okay, let's dive into this. Area 3 makes up about 5 to 15% of your REG exam. Now, I know that percentage might seem a bit modest at first glance, but trust me, it is absolutely foundational. The principles you master here are going to directly impact how you handle the much larger, more heavily weighted questions on individual and entity taxation later on. So what exactly does Area 3 test? We're looking at routine property transactions for both individuals and entities. The two major pillars we care about are the basis of assets and cost recovery, which covers your depreciation and amortization. Like I mentioned, this is highly connected to individual and entity taxation. You simply can't compute a partner's distribution tax consequences or a corporation's recognized gain on a sale without establishing the tax basis first. Basis drives the future tax consequences. It literally dictates the gains, the losses, the deductions, and ultimately the final tax bill. Let's lay down our core definition. Tax basis is essentially your tax investment in a property. Think of it as the amount of capital a taxpayer has put into an asset, which they are eventually allowed to recover completely tax-free, whether that's over time, through depreciation, or all at once at the point of sale. Understanding exactly what makes up this initial investment is your starting line for literally any property transaction problem on the exam. So the crucial point is that basis must be established before you do anything else. The sequence of operations matters immensely here. Your basis usually starts with the asset's cost, or it's going to follow a specific tax basis rule depending on how the property was acquired. As time goes on, that initial basis will be adjusted. You might increase it with capital improvements or decrease it by allowable depreciation. Your calculations for depreciation and amortization almost always depend on this starting basis. And finally, there's just no way to calculate a recognized gain or loss when you sell the asset without knowing that adjusted basis at that specific point in time. Here's a map of the starting basis rules based on how the asset was acquired. Now, a word of advice, don't over-teach yourself on the tiny, obscure exceptions here. The exam logic simply requires you to identify the acquisition method and then apply the rule. If a property is purchased for business use, the basis is just its cost. Simple. If a personal asset is converted to business use, your basis is strictly the lower of its adjusted cost or its fair market value at the date of conversion. For gifted property, you generally use a carryover basis, meaning the donor's adjusted basis just transfers right over to the recipient. The only time that changes is if the dual basis rules for losses kick in, which means you'd use the fair market value at the date of the gift if it's lower, just to prevent shifting built-in losses. Inherited property, that gets a step up or a step down in basis to the fair market value at the date of the decedent's death. And for stock acquired through a wash sale, you just add the disallowed loss to the basis of the replacement shares. Now, intangible assets follow their own strict set of starting rules. For purchased intangibles acquired in a trade or business, these are your Section 197 intangibles, things like goodwill or customer lists. The rule is rigid. You have to amortize them straight line over exactly 15 years for tax purposes, regardless of what their actual useful life is. When it comes to business startup and organizational costs, the tax code gives you an immediate deduction of up to $5,000, assuming your total costs don't exceed the statutory threshold. After that, any remaining amount is amortized over 180 months. Finally, for loan origination costs, you're going to capitalize those and amortize them over the specific life of the loan. Once we have our basis locked in, we move to cost recovery. Cost recovery simply means deducting the cost of your business or income-producing property over a period of time. For tangible business property, you'll do this using MACRS depreciation, the Section 179 expense deduction, and bonus depreciation. These are all dictated by specific recovery periods and conventions, like half-year or mid-quarter. For intangible assets, recovery happens through those strict amortization schedules we just walked through. And hey, don't worry about memorizing massive tables. For complex calculations, the exam generally provides the MACRS tables, specific statutory rates, and phase-out limits when you need them. Your job is just knowing how to apply them correctly. And this brilliantly illustrates exactly what you'll be tested on when it comes to cost recovery. The examiners want to see if you can determine whether a specific piece of property is even eligible for a deduction in the first place. You'll need to pinpoint the correct depreciable or amortizable basis, and you'll have to prove that the calculated expense amount is dead-on accurate. You're also going to be tested on the proper application and the correct ordering of Section 179 expense versus bonus depreciation, making sure you recognize the limitations and qualifications for each one. To navigate these questions successfully, you need a reliable framework. Whenever you encounter a property transaction problem, I want you to walk yourself through this exact logical sequence. Step 1, what type of property are we dealing with, and exactly how was it acquired? Step 2, based on that acquisition, what's the starting basis, and has it been adjusted by improvements or prior depreciation? Step 3, is the property depreciable or amortizable, and what specific recovery rule applies here? And Step 4, carefully read the final sentence of the prompt. Is the question asking you to calculate the adjusted basis, the current year expense, a recognized gain or loss, or the accuracy of a tax return schedule? Stick to the sequence and you won't get lost in the weeds. You should absolutely expect this material to show up in task-based simulations. One major TBS angle is reconciling book versus tax differences. Book depreciation under GAAP is based on the matching principle, an estimated useful life, and goodwill is simply tested for impairment. But tax depreciation under the Internal Revenue Code, that uses statutory MACRS recovery periods, and as we know, goodwill is strictly amortized over 15 years. You'll frequently see simulations that require you to identify these permanent and temporary differences to adjust financial income and arrive at taxable income. Another common TBS angle is reviewing and auditing depreciation schedules. You might be handed source documents like invoices or fixed asset roll forwards and asked to catch intentional errors. You've got to be on the lookout for assets missing entirely from the schedule, or assets loaded with the wrong starting basis. Maybe there's an incorrect placed in service date, which, trust me, throws off the entire calculation. You also need to catch the use of a wrong MACRS recovery period, an incorrect convention, like forgetting the mid-quarter convention when it's required, or someone trying to apply Section 179 or bonus depreciation to ineligible property. Let's move to and see how this builds with 3 short original examples. We'll use simple round numbers just to see the framework in action. First up, purchased equipment. Let's say a business buys equipment for $10,000. The acquisition method is a purchase, so our starting basis is exactly that $10,000 cost. Assuming it's 5-year MACRS property using the half-year convention, the year 1 table rate is 20%. So 20% of $10,000 gives us a depreciation expense of $2,000. That means our adjusted basis at the end of year 1 is $8,000. See, it's a straight mechanical application. Our second example looks at a personal asset converted to business use. Let's say a taxpayer bought a vehicle for personal use that originally cost $20,000. Later on, they decide to convert it entirely to business use. On the date of that conversion, the fair market value has actually dropped to $14,000. Now, the tax code completely restricts you from deducting that decline in value that happened while it was a personal vehicle. Therefore, your starting depreciable basis is strictly the lower of cost or fair market value at conversion. In this case, that's the $14,000 fair market value. For our third example, let's contrast gifted versus inherited property. Imagine a piece of land originally cost $30,000, but today it's worth $50,000. If that property is transferred as a gift, the recipient takes a carryover basis. They literally step into the donor's shoes with a starting basis of $30,000. But if that exact same property is transferred as an inheritance upon the owner's death, the beneficiary gets a step up in basis to the fair market value at the date of death. So their starting basis becomes $50,000. Simply identifying the nature of the transfer is the only way you're going to get the basis correct. Before we wrap up, we need to talk about the exact traps the examiner is going to set for you. A primary trap is asking for a gain or loss on a sale and giving you the original cost, just hoping you forget to subtract the accumulated depreciation to find the adjusted basis first. They will also try to get you to confuse cost basis, adjusted basis, and fair market value all in the same problem. They'll test if you remember that personal use property is never depreciable. They'll wait to see if you forget that lower of cost or FMV rule for conversions, or if you mix up the carryover rules for gifts with the step-up rules for inheritances. And finally, they will definitely trap you if you assume all intangibles are handled the exact same way, or if you confuse GAAP book depreciation with IRC tax rules. Area 3 is a basis and cost recovery area. First, identify the property and how it was acquired. Then determine basis, adjust it when needed, apply depreciation or amortization rules, and use the result to calculate expense, gain, loss, or return impact.